Cool, guys. I think let's kick off. Thank you so much for joining us this morning. It's great to see all of you again. Really come to enjoy these monthly sessions with all of you. This will be our second last one of the year. The last one will be on the 16th of November next month. But I think this is quite an important one. I joked about it just now, but it is that time of the year when we are sending out Q3 statements. And unfortunately, it's a very different experience this year to what it was last year. Those of you will remember when you were sending out your Q3 statements in 2021, it was a very happy affair. Markets were doing well and it was green all around. This time around, very, very different story. And I think with that in mind, the seed team wanted to approach today a little bit differently. And we actually want to try and answer 4 key questions that we get asked a lot by you guys and by your clients. And those 4 key questions are there on the screen. Those are by no means an exhaustive list of questions, and there will be an opportunity at the end for you to ask any additional questions. But we thought if we can touch on these 4 questions, we can just help you understand maybe a little bit better what has happened so far in 2022, so that you can, of course, in turn articulate that to your clients. And also just on that note, Carmen will be sending out later today the monthly commentary that we normally attach to our client statements for those of you who are with Seed Analytics or do your own thing. We've also done an additional thing this month. Lisa did a nice little 2-paragraph write-up that you can copy and paste into the body of your email, just to position the statements, and also a lot of clients don't necessarily open the attachment, which is the monthly overview, but at least in those 2 paragraphs, you can then give the client a sense of what has happened in the last month in their investment portfolio. So look out for that communication from us a little bit later today. And if there's anything else you need that we can help with, please just shout. So the 4 key questions is the ones on the screen. And I think on that first question, you will recall from our session in the last quarter of 2021, we always expected 2022 to be a tough year with high market volatility. What we, of course, did not expect was that Putin would invade the Ukraine and set in motion a chain of supply and inflationary bottlenecks, particularly in the energy and food price sectors. So as inflation has persisted, central banks realized that it will not be transitory as they'd hoped initially, and they aggressively started hiking interest rates across the globe. And of course, this cycle of interest rate hikes has had substantial consequences for asset valuations and for the real economy. And on that note, I'm going to hand over to Ian to pick up the question from here. What caused markets to behave the way they did this year? Ian, thank you. We look forward to your insights.
Great. Thanks, Adriaan. And awesome, guys, to be with you again. As Adi said, second last one of the year, an important one, given where the markets are for the year to date. Okay, so I've got a lot of slides. Let's get into it. I think let's kick off with a quote from Sir John Templeton. And one of his famous quotes was, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Time of maximum pessimism is the best time to buy. Time of maximum optimism is the best time to sell." So I'll leave it to you as to decide in which state we are in. We've got some views, but let's take it through and try and answer some of that first question that Adriaan was asking. I thought let's take it first back to basics. And I think if we look at things, there's 2 main forms of investments: ownership assets or ownership investments and lending investments. And under ownership investments, we've got real estate, shares, and collectibles. Under lending investments, we've broadly categorized them as sovereign bonds and corporate credit. And if we look at examples of each one of these, we've got, and we understand this, so this is not new to all of us or to any of us, but it's I think important to try and understand the lie of the land and see where we are now. So we're under ownership, we understand real estate. own an asset, own a building, residential, commercial, rent it out, derive a rental income. Shares, we talk so much about shares as investments, but it's not the only investment, and that's what we're trying to look at here. But we understand that it's an ownership in a company. It is typically the most rewarding. It's got unlimited upside, but it's also the most risky and most volatile. And there's a lot of reasons for that. Because I think the main one is that generating a profit from a business is extremely challenging. A lot of issues and stakeholders demanding. So you've got competition, you've got regulation, unions, politics, changing customer demands. So all of these stakeholders ultimately have to be satisfied before you, as the investor, derive an earnings yield. And then that comes back to you as the investor in the form of dividends, and then the balance is reinvested. And then collectibles we will put under here, maybe art, but typically the one that we look at is gold. It just sits there. It doesn't generate any earnings yield. So those are ownership assets. You own the asset as the investor, deriving typically a rental income, earnings income, or in the case of the gold, no income. And then the one that we tend to forget about a fair bit in a lot of discussions is this one, which is lending investments. And there are a number of ways to categorize these, but as I say, we've categorized them as sovereign and corporate. Sovereign loan, quite simply, a government issues money, issues a bond. You as the investor loan the money to the government and derive a fixed interest rate. A corporate is essentially the same. It's just not a government that's issuing. It's a corporate, and that's either a bank or a company that wants to raise debt. And you as the investor obviously provide that at a fixed rate and at a fixed maturity profile. So these are two forms of investments, but what is very important and what's, if we move to the next slide, is very important is that interest rates on the loan investments and the valuation of the ownership investments or ownership assets are joined at the hip. And this chart here tries to demonstrate a degree of that, because really what we've had in terms of the joining at the hip of these two assets is the scenario where for 13 years at least, and it actually even extends back, but definitely for the 13 years, we've moved into a situation of zero interest rates. And when you as an investor are getting pretty much close to zero on your loan investments, what does that mean? More and more of your money is moved to ownership assets. And we know what happened. This is going back to the global financial crisis in the US, but obviously that set the scene for around the world. And so over these last 13 years, more and more money has moved to ownership assets. And obviously that has driven up the valuations, or not the valuations, it's driven up the price of ownership assets with the zero interest rate policy. In fact, it actually goes back to, as I've circled here, just from 2009, but in fact, this actually extends back to the 2001, where we had the 9/11 crisis, where we had the dot-com fall, and interest rates were taken not to zero at that point, but ultra low rates, around about the 1% level. And that was the seeds that were sown for the global financial crisis. And then it's just been exacerbated from then onwards. So that gives you some sense. And then on the next chart shows a very similar thing, but this is not the short-term Fed funds rate. This is the 10-year bond rate in blue there, relative to the earnings yield. And just to give you some context here, so this is going back to 1979, effectively the start of the massive bull run, 40-year plus bull run that we've had in equities. And essentially the red line is the earnings yield. So that's what you get as an investor. As I said earlier, in the form of dividends and reinvestment back. And your earnings yield is a good proxy for the rate of return that has been generated. And then the blue line is your is what the yield that you derive as a lender of money. And you can see there's been a high correlation all the way through, but to some extent that the correlation has been there, but I mean, the gap opened up dramatically as the interest rate environment got lower and lower and lower, and that helped prop up the return that was generated on ownership assets. The red line is a good proxy, a very close proxy, an approximation to what you get. So as you can see, if you go back to early 1980, where the earnings yield was at 16%, if you take the return that was generated from equities at that point in time, if you had invested, which was a very, very weak point in time, equities were totally bombed out as interest rates moved up. That's the type of return that you would have received, 16% in dollars over a multiple period. And then so it goes all the way through. The long run, and this is obviously on the S&P, the long run type return average for a long period of time, excluding that early very good period, it's been in the sort of 8.5%, 9%, 10.5% level. But as you can see now, what's happened is the interest rates have shot up dramatically, and that's put pressure now on the prices. So if we go to the next chart, we can see that it's not only in the US, we tend to focus on the US, but this just gives you a little bit of a sense of what's happened in the G6 countries, all of them barring Japan, where the 10-year yields have spiked up dramatically. And these charts go back to 2000. So it's 22 years. And you can see the sharp and massive spike up in yields. And this has had a dramatic effect already. And I don't think we've seen all of it because it's been so sharp over such a short period of time. The only exception is Japan. And the reason why it stayed at the 0.25, so their interest rate on the 10-year bonds is 0.25%, i.e. you as an investor are lending money to the government, saying, here, Mr. Government, here's my $1 million equivalent. What rate can I get? Oh, you can get 0.25% per annum. The reason that hasn't moved is because it's effectively been manipulated down. The government of Japan is squashing that interest rate down and keeping it at the 0.25%. But everywhere else where there's a degree of market, more realistic market, rates have moved up dramatically. And we see what's happened in the UK there. That has been such a severe and sharp move that it's had ramifications already on their pension fund environment. So these yields have been short and sharp over a very short period of time, very sharp moves. If we move to the next slide, this is one that's starting to impact property in the US, especially now, and this is your mortgage rate. So unlike what we have here in South Africa, in the US, they typically, the borrowers to buy your home typically go for between a 20 and 30 year, and they can fix their rate. And as the rate has come down, so you can refinance, fix your rate at the lower rate. And it doesn't, it's fantastic for both parties. But what we've had is the 30-year rate move up dramatically to around about the 7% level. This shows just over 7.25%, 7.24. It's a massive move up, and it's only now starting to have consequences on the property market. And as we know, the property market is a huge and substantial market for ownership, and it has ramifications throughout the banking system as well. And so we know what's happened. The property market moved up to very, very high levels. But this is effectively a break. It's literally slamming on the brakes and saying, okay, we need to reassess. So we'll see what happens here. If we take a look back, and this is, it's quite a busy chart because it's put all these little pointers on, but essentially this is the US 10-year interest rate over right from 1960. And each time we've had a spike up from a previous sort of period, it does tend to have ramifications. And this has just penned a few of those problems down, over the course of history. So we know the big one was the 2000, many of us do remember that, we were there, the subprime mortgage, the global financial crisis, so that was in 2007. As I say, the seeds of that were sown when interest rates were brought down dramatically from 2001, 2, 3, and that boosted up property dramatically. The amount of debt went crazy in the US, and then suddenly we had a banking crisis, and it spilled over to a lot of the places around the world. And so the interest rates had to be hiked up. But as they were hiked up, it caused problems. And so if you go back over time, you had in the early 90s, the savings and loan crisis. You had the Mexican peso crisis. Each time the crisis was typically as after interest rates have moved up dramatically. Here, we don't have any crisis as such. Yes, asset prices are down, but not any major crisis yet. But there are a few signs. One of them is obviously the pension fund debacle in the UK. But you can see on this chart just how severe this current move up is, and it's akin to so many of the other moves that we've seen over a course of history. So that's the 10-year. Are there tensions in the market? There's definitely a lot of tension. So I've noted down some sort of anecdotal evidence of tensions. The first one is that there is a degree to which some banks are under pressure. We've cited the example of the Credit Suisse, Deutsche Bank. There definitely are some potential problems there. Credit Suisse has had to write down a lot of their assets. They came unstuck with a lot of bad lending that they made. And the price if you look at the share price of that, it doesn't make for a pretty picture over let's say 20 years. Even now, I think over the weekend, they've had to offload their asset management division, or on the process of trying to offload. So they're trying to shore up their assets or trying to shore up their equity. And remember, banks are very highly geared companies, essentially. They have a sliver of equity, and it's really a high amount of debt on their balance sheets. And so these type of moves can and will put a lot of pressure on them. There is some talk about a lot of range of smaller banks, not the likes of the Credit Suisses of the world, because you've got a range of banks. There's a lot of smaller banks, which are maybe more regional type banks, which suddenly have problems on their balance sheet, where they actually potentially could run into insolvency issues. I mentioned the UK pension crisis. Suddenly, as those yields spiked up, you've got a lot of pension funds in the UK, which are sort of driven by this liability-driven investments. Essentially, they've had to reach more and more and more in a lower return environment, where they've got this obligation to their pensioners. It gets more and more difficult to meet that obligation in the future years. And so there's a degree to which a lot of those pension funds have geared. They've used bonds as collateral to provide, to actually gear up their balance sheet a bit to provide that pension in the future years for pensioners. And suddenly, when your bond yield spikes up, what does that mean? Well, it means your asset price comes down dramatically. 75% in the case of some of those long bonds. And so they've had to suddenly under pressure, to the extent that the Bank of England said, we've got to come to the party and try and backstop this. So I don't think we've seen the end of that yet. We know what's happened with the dollar as interest rates have moved up. So the dollar has been obviously super, super strong and put huge amount of pressure on the euro and the sterling and the yen as currencies. And that also will have ramifications and has had some ramifications. As I mentioned, the mortgage rate's at over 7% now. We're definitely starting to see, there was some stats that came out yesterday on the US property market. And that is a huge market. And suddenly people are stuck. If you can't, and I've even seen anecdotal evidence. Let's say you're in a home and you fixed your mortgage rate at 3%, 3.5%, fantastic. This particular individual was offered a job in another state, but he's stuck now. He can't sell his house. As soon as he sells his house and goes and buys another place and remortgages it, he's stuck at the 7% level. And so the repayments are effectively doubled up and even more on these levels of mortgage rates. The other factor which I'm starting to see now, and I think this is going to be important, is that there's a lot of highly geared companies. And remember, the lower the debt, a lot of companies, small and large, have taken on debt and geared up their balance sheet, because if you're giving away debt, if you're giving away money at super low rates, it sort of makes sense to do that. And so your balance sheet is coming under more and more pressure. Fine if it's managed properly and you've got a stable income generating business, but many businesses are not, and suddenly you might find yourself in a scenario where you've got to roll that debt over at much higher rates, and suddenly it puts a lot of pressure on the company. And obviously, who takes the knock? Well, the equity owners take a knock. And so there's a lot of companies that won't survive, and that's not necessarily a bad thing. I think it's a good thing for stock pickers who can properly select. We want to avoid certain companies. We don't want companies with highly geared balance sheets. We just need to make sure, can this business survive? And obviously for those big businesses and large businesses that can survive with strong balance sheets, well, they're going to be picking up assets, cheap assets. So it's not necessarily a bad thing. I think it's a good thing. Because, if you've got a risky balance sheet and you can't survive, well, someone else is going to come and take that off your hands. And so it is potentially a scenario where the strong get stronger. So those are some of the things that we're starting to see. And this is all a result of higher interest rates. Okay, so what should investors do now? I think the big thing is that there is this distinction between investing as not only ownership assets, but also lending assets. And we tend to forget that a bit. But in a multi-asset environment, we are saying that maybe selected investments, i.e. sovereign bonds, at these better interest rates, far better. 4% now. I see yesterday the interest rate on the US 10-year is just 4.06%. So that's effectively lending to the government at 4%. Well, now we know that it could go weaker. We know that the rate could go to 4.5%, could go to 5%. But at 4%, a whole lot better than 0.5%. And it's a whole lot better than lending to the government of Japan at 0.25%. At the same time, we do know that prices have come down substantially. And obviously, this is the thing that concerns clients. They look at my price has come down. But I think what we want to discuss, and part of the thing is, if you are not only a long-term investor, but you're constantly adding to your position over time, as many investors are, especially through their pension fund, well, you're buying assets at these much cheaper prices. So as the forward earnings yield has moved up, dividends yield have moved up, valuations are improved. We're not saying that they are super cheap. And that's the same message that we've been saying. So it's not like they give away prices. So getting back to the quote of Templeton, I don't think we're at the point of maximum pessimism quite yet, but there's a large degree of pessimism coming in. It's debatable whether we're at the point of maximum pessimism. So those are some of the points, and I hope that sort of answers that question. I think the important thing is that linkage, and I think the thing is we mustn't forget is that it's not only about share prices. I think what we are seeing is that there's a lot better value for effectively savers, whereas before there was no interest rate around the world. We've been lucky to some extent in South Africa. We've had high interest rates, but around the world it's been an absolute mess where you've been forced to go into risk assets, and now it's a lot more appropriate in terms of the interest rate environment. So I think it's a positive thing that we've actually got a sort of reassertion of reasonably appropriate interest rates. Thanks, Adriaan.
Yeah, thank you for those insights. It's always so useful to gain a base understanding of the underlying drivers that's impacting our world. And in an environment where, like you rightly say, where interest rates are zero or close to zero, it's almost forced so many pensioners around the world to actually take on risky assets, and maybe that opportunity set has changed now. And I guess a big question as well is just, given the expectation for inflation and interest rates, has the market fully priced in the full interest rate cycle? And as you say, at what point will it start, assuming all other risks being equal, at what point will the market start looking through this current rate hike cycle to where rates will flatten out and potentially even start decreasing in the future? And we know that's normally very good for your risk assets when that starts to happen.
Yeah.
But just to look back on 2022 and how the actual asset classes stacked up so far, that's the statements that you'll be sending out to your clients today. Mike, will you give us some insights on that, please?
Yeah, unfortunately, not such good news for how things have gone so far in 2022. As Ian said, a lot of these global shifts have really impacted across the board. So if we can go across there, Lisa. And I think when we start, obviously globally, there really hasn't been anywhere to hide. So when we look at a 60-40 portfolio, to a typical balanced portfolio with 60% allocation to equity and 40% allocation to bonds. To the end of September.
Again?
To the end of September.
How are you?
Guys, do you mind just muting your mics in the background there? Thank you. Back to you, Mike.
To the end of, calling a mic, so that might be me. To the end of September, I mean, the 60-40 portfolio, your typical balanced portfolio, has had the worst year-to-date return. I mean, they put over the past 100 years. It's probably kind of forever, given the length of that the financial markets have been around. So it has been tricky. I think one of the key pointers from my section of this presentation is that we have been in quite unprecedented times. So it's quite normal for you guys and your clients to be feeling like it's been a bit of a rough patch. But hopefully we can give you something to look forward to going forward. So yeah, globally, a 60-40 portfolio, nowhere to hide. We skip through to the next one, Lisa. Looking purely at the equity, so again, on the global side, looking at the S&P 500. This is one of the worst periods year to date over the first 3 quarters. But I think the important thing is we've had this period now. Whenever we look at investments, it's what's in the price, what's going forward. And if you take the 10 worst starts to the year, and then you look at how they've done over the next quarter, so this would be the fourth quarter for 2022, going into 2023, and sort of going forward 1 year, there is generally a high probability that we will generate positive returns going forward. It's not a guarantee. And you'll see 2001, obviously, there was a weak start to the year. We had 9/11 just before the end of the third quarter in 2001, and then essentially recession in the US and the dot-com bubble bursting. So for the next 4 quarters, it was a very tough environment. 2008 as well. Ian's gone through that, the global financial crisis. If we go into a period of a deep extended recession in the US and by implication globally, we could still see some negative returns going forward. And as Ian said, we don't have the crystal ball, and we don't necessarily think that we can't quite ring the bell and say we're at the bottom. But on a balance of probabilities, going forward, we would expect to see better returns over the next quarter, next year than we have had over the first 3 quarters for this year. And then the problem for us as South Africans as well has been exacerbated, or typically you get buffered by a weakening rand. We have obviously had the rand weakening for this year. I mean, it's down over 10% versus the dollar, And typically in that environment, while the local assets might have done poorly, our global assets, when you convert them into rands, have offered at least a bit of support to multi-asset portfolios and the like. The reality is that US cash has been the only place to hide this year. So as an investor, if you invest in a South African investor, if you invest into US cash, you're sitting pretty. If you're sitting in SA cash, maybe a little bit of small caps or inflation-linked bonds, you've largely treaded water. But otherwise, if you're looking across bonds, the various sectors locally, mid caps, large caps, property, all down kind of close on double digits. Your global assets, even when you convert them back into rands, have been down. And so we can see that the average multi-asset high equity fund is down over 5%. So it has been a tough place to invest, and as we can show here, there's really been nowhere to hide other than, as mentioned, either dollar cash or a bit of SA cash. So it's only the people who've been very, very conservatively positioned, and I'd argue most of those people who've been conservatively positioned this year would most likely have missed out on a lot of the gains that we had last year. So over a 2-year period, maybe not looking as pretty, but for this year, that's where the returns have been generated. And then finally, in terms of just looking at the various returns that one can get, I've taken the multi-asset high equity average fund, looked at their returns over a rolling 1-year period going back into the 90s, and you can see that we're currently sitting where the average multi-asset high equity fund has done 0% return over the past 12 months. And while this isn't unprecedented, it's only less than 10% of the time that these funds do generate negative returns. As we discussed maybe earlier on the global side, you can see 2001, 2, and 2008 were the periods where we had some sharp drawdowns. So not to say that things can't get worse. So it's imperative that you brace yourself and I guess warn your clients that while things are bad, that they could potentially get a bit worse. But the reality is that we a lot closer to the bottom, and poor returns are typically a catalyst for good future returns. And yeah, I think we can all feel a bit like this dog. This dog is standing in the US, particularly US jobs, hawkish Fed, housing market, inflation, trying to balance on them. It is a tough balancing act. As you can see with the dog's tail, it can be quite a scary environment to be in. But I think that the key for us is that markets are forward looking, and kind of reiterate the quote that Ian shared at the beginning from Sir John Templeton: that bull markets are born of pessimism, grow in skepticism, mature in optimism, and die in euphoria. The time of maximum pessimism is the best time to buy. Time of maximum optimism is the best time to sell. And as we said, I don't think we can emphatically say that we're at the time of maximum pessimism, but we're definitely getting very close. And so within our portfolios, we are still fairly conservatively positioned. We haven't loaded up on risk assets, but definitely the discussions within the investment team at investment committee level we're sort of looking for those indicators to come to us, to show us, okay, now is the time where we need to start upping our weight. So that is something that we are actively looking at. We're not acting on it at the moment, but we are in a position where we're rather looking for opportunities to increase exposure across our portfolios to growth assets, rather than looking to sort of reduce, because clearly we're not in a time of maximum optimism. Thanks.
Thank you, Mike. Guys, we will have time for questions at the end, but if there's any burning questions, you're welcome to put your hand up and put it in the comment section or just ask it. If we then sort of say to ourselves, and this is a question Miguel and I get a lot from all of you, So what does this all mean for how I invest my clients' money? So I've got a client with R1 million, they want to go offshore. What do I do? And I think for us, in volatile times like this, it's just so important to get back to investor strategy. Lisa, if you wouldn't mind just putting that up. You all have seen this slide before, but I think this can absolutely be your and your client's best friend in a time when the news wires, client reports, the investment growth has been negative and things are as volatile as it is. And just to look at this, if you look at on the far left side, the good news is that if we take a retired client with a living annuity, if you'd invested sort of that around about 3 years of income into the income pot, which typically we would recommend a blend of income funds, as Mike just showed, those are sort of some of the only funds that are positive year to date, and most of them are. So your client would have been drawing their monthly annuity from that positive pot or a pot of income of portfolio that at least has had positive returns. And the other good news is, as interest rates are rising, of course, your gross yield and your income funds and then your money market and deposits, fixed deposits, are also increasing. For example, the seed income gross yield is now 9.92%. And you will remember not so long ago, before the hike cycle started, it was around 6.5%. So we've seen a very nice pickup in the gross yield and income funds. So you can put your client's mind at ease that their short-term funds, the emergency funds, or that deposit that they're saving for a car has had positive growth so far in 2022. Of course, as we move to the right of the investor timeline past the 3-year point, and we start introducing growth assets into clients' portfolio, a whole different experience with negative returns year to date. But I think in that instance, it's very important to remind ourselves and the clients that when you expose your portfolio to risk assets, be it equities or bonds, those always move in cycles. And we did a long-term view on the JSE over the last 60 years. We've shared this with you in the past. Out of that 60 years, roughly 75% of the time, the JSE is positive. Roughly 25% of the time it's negative. In other words, 3 years out of 4 should be positive on average for a client, and 1 out of 4 should be negative. So if a client's investing for retirement, or a client has got at least a 10-year horizon on a discretionary investment, they should expect on average 2 bull cycles and 2 bear cycles during that 10-year investment phase. And if we have that discussion with a client up front, and we show them the range that a equity fund could do over a 12-month period, could be as low as 30%, it could be as high as 50%, and clients understand it when they go into the investment, then it makes discussions at this point in time a lot easier. It's never easy. I don't for one second think that, and Miguel and I have had many discussions with you and your clients through this last couple of months. But it just means that you and your client can find peace and comfort that you've put a proper investment strategy together. The short-term liquidity is taken care of and funds that's yielding positive yields. And the long-term investments, best to leave those alone, let them recover from the losses they've experienced, which at this point is a paper loss. Let it recover back into positive territory before we start topping up the income pot. And of course, if somebody's coming into the market, as Ian said, albeit through monthly debit orders or a lump sum. On a monthly debit order, you're getting that nice cost averaging. You're buying in at this point in time much better valuations than you bought a year ago. As Mike said, is it the bottom? Was Friday the bottom? Is the bottom coming in 2 months' time? We don't know that. But we do know they're buying better value today than they did a year ago. And for a long-term investor, that's a good thing. What we would recommend for lump sums is that you consider phasing your clients in, be it local or offshore. It sometimes means a little bit more administration on your side, but we think given the current volatility, given the uncertainty and all the risks that Ian mentioned, it's probably a prudent thing to phase clients' investments into risky assets at this point in time and to just go offshore. So the last question we want to just touch on is what the Rand is going to do next. And as Mike will tell us now, maybe the right question to ask is not what the rand will do next, but rather what the US dollar will do next. Mike, over to you.
Thanks, Adriaan. Yeah, so I mean, I think it's the age-old question for South African investors, particularly, I guess, your slightly higher net worth individuals who've either got aspirations of being able to immigrate or have hard currency costs that they've got either through going overseas or having children overseas or various other requirements. And I think for most of the time, it is about the rand. How's the rand looking versus other currencies? And when we talk about other currencies for South Africans, it's typically dollar, pound, euro, and usually those three currencies move in tandem compared to us. And we all sort of, South Africa, the rand sits in a bucket with maybe some other emerging market currencies. But I think the reality, and I'm sure again most of you guys are aware, this year it's all been about the dollar. Dollar is super strong. So here we've got a couple charts, deviations from purchasing power parity. So I mean, this is the kind of work that we do for the rand. We look at the rand versus not only the dollar but the euro and the pound versus purchasing power parity, and you can see just how overvalued the dollar is as a result of I guess a very tough geopolitical environment. The dollar is a political safe haven. The US Fed has been the most aggressive in terms of hiking rates. So as Ian mentioned, your US 10-year was only generating a 0.5% yield not even 2 years ago, and it's now giving you a 4% yield. So that's caused a lot of money to flow into the US market. And on top of that, sort of the economic environment is quite tough, and typically that's when the US dollar does well. So we can see dollar is very far from purchasing power parity on the left. On the right, you can see the dollar on a purchasing power parity basis versus its long-term history. So we kind of only in the mid 80s was the dollar this strong. We know with purchasing power parity, it's not the sort of sharpest elastic. Currencies can move away from fair value for quite some time. We see that in South Africa as well. But mean reversion is a powerful trend. And while we're not predicting that the dollar's peaked at the moment, and again, it'll come hand in hand with the markets. We do know that the dollar is much more likely over if we take a bit of a longer term view. So we can't the sort of next few months it'll be highly sort of data dependent, but over the next, call it 12 months, 24 months, you would most likely see the dollar starting to roll over as I guess a lot of these issues, high inflation, hiking interest rates starts coming through the market, and the market starts seeing through them. We could start to see the dollar weakening, against a basket of hard currencies, but also potentially against the rand. So as Adriaan mentioned, I think key for guys who are wanting to externalize their assets, the first question is to what currency. If you have a client that's looking to immigrate to somewhere like the UK, now's a great time to be buying pounds as a South African. So not necessarily needing to maybe phase in so much or over such a long period going into the UK. Whereas if they're wanting to get into dollars, they would recommend the phase and approach. And again, depending on what timeline you have, you obviously need to manage that.
Thank you, Mike. Guys, we've covered those 4 questions, I hope fairly extensively. We can obviously spend a whole day talking about some of these topics, but we wanted just to give you a sense of our thinking and our view of the lay of the land. Is there any other questions from your side that we haven't answered that you'd like us to touch on? We, of course, don't have all the answers, but we do apply our minds to these things on a daily basis and try and make sense of it all as best we can. Ian, maybe just a question from my side. In your session, you spoke a lot about interest rates, but maybe just very practically, if you think of the share market revaluation, if you take a share like Apple, when interest rates were close to zero, and what was the change in Apple share price from valuing an Apple share price from a low interest rate environment to now where the cost of capital has gone up? How would rising interest rates affect an Apple share price?
Well, the biggest factor, and that's what we've seen so far, has been that as the interest rate moves up, it's your discount rate that is applied to earnings. So that's what we've seen so far. So what's actually happened, and this is what the market's looking at, trying to anticipate now, is where our earnings going to be. So we've seen some earnings season starting now. Netflix came out, just as an example, last night with better than expected results. After the market closed, the price was up 10% of Netflix. Obviously, it's taken a massive dive already. But essentially, the first aspect I think there's two components to the high interest rate, and that is the first thing is that it's your discount rate. So as these rates are moved up, by definition, all asset prices have to move down. That is just the mathematical way that you value a stream of the earnings of a company. So Apple's going to generate earnings into the future. All the companies going to, and you just have to discount that now at a much higher rate. And that's immediately what the market's done. So the higher interest rates, immediate impact. And then I think the secondary issue is, okay, now has that particular company got cash on its balance sheet, or has it got debt on its balance sheet? And I think this is now, and then what is the earning stream going to be? But how strong or robust is the balance sheet? I was going to do a bit of an exercise last night, but I didn't quite get there. Just a simple thing. Think about an Apple. Think about a Berkshire Hathaway, which in fact is its biggest holding is Apple. It's had a lot of cash on its balance sheet, which has just been sitting idly there, earning no earnings. Now the 3 months rate has gone up to 4%. The 6 months rate has gone up to 4%. Suddenly, it's going to be generating earnings out of that. But a lot of other companies have got the opposite. Obviously, they've got the debt on their balance sheet. So I think we haven't seen that aspect yet. We've seen the immediate impact in terms of the highest interest rates, in terms of discounting the future earnings, and that's brought company share prices down 25%. Now we're going to see, okay, who are the strong players, who are the weak players? And there's a lot of weak players out there. And that's why we're starting to try and think, and we've obviously, then again, it comes to the argument, passive versus active. Up until now, if we think about it, for 13 years, it's been a rising tide. Low interest rates, good or bad businesses, everyone has just gone up and up and up. Yes, there's been an exception, but in general, that's the case. Now, suddenly, with a high interest rate environment, with weaker companies out there, maybe it's not necessarily going to be just a matter of a rising tide. Maybe now that the tide has gone out, maybe some big waves are coming along. And so now, perhaps, and I think this is what we're going to start seeing, maybe it's not a matter of just passive is just the way to go. Maybe stop picking, because there's a lot of businesses that you don't want to be owning that are just they're not going to cut it. They're not going to generate the earnings, and you're going nowhere as an investor. So anyway, these are some of the things I think we're going to start seeing in the time ahead.
Thank you, Ian. Guys, any other questions from your side? Tomo?
Yeah, Ian, what you're saying is that some of these companies have got a permanent 25% discount being applied because the discount rate has obviously changed. So it's possible that they won't recover from their current positions unless there's serious revised earnings growth to the upside.
Yeah, look, I mean, if this, we can see how, look, that discount rate applies to all businesses. So the discount rate is immediately applied across the board to all businesses. So I mean, if you look at the way you do evaluation, you start with your discount rate, and then you say, okay, should I be applying a higher discount rate to this business because it's a riskier business? Yes or no? A good, super solid quality business, okay, apply a lower discount rate. So so the base rate, which is your US 10-year rate, applies across the board to all businesses. We could very well see a strong rally, and as Mark said, I mean, we've obviously coming off a lower base, and it is data dependent, because if the inflation numbers comes off a lot more than what the market is currently pricing in, immediately we're going to see, time for the Fed to pivot. The Fed's going to be dropping rates at some point. Okay, we're reaching the top, and that means, okay, the discount rate can come down, or at least we've reached the maximum of the discount rate. But as we've seen up until now, each time the market's been a little bit behind the curve. Inflation's a little bit higher. Okay, the Fed has got to just keep twisting and putting up that interest rate.
Just going back to that. Sorry,
Yeah.
thanks. And then just looking at that high equity chart, I mean, we're currently sitting in an environment where, I mean, I think it's only 2 periods in the previous 30 years or so where your high equity funds have yielded negative returns. I mean, it's kind of 1 in 10 years, 10% of the time. Given the information that's at hand, and obviously we don't know if we anticipate that we haven't quite reached the top of the hiking cycle. We haven't seen the US looks like it's possibly in recession. The earnings season will be fairly interesting in terms of how that's, and the market's obviously pricing a lot already. I mean, it's 6 months sort of forward thinking, but I mean, on your best sort of view, what are the likelihoods of things going much lower than they already have? I mean, we seem to have found a bit of a bottom. There's a lot of volatility, but there isn't any sign that it's going to suddenly drop another 20%, but it's not out of the question.
Yeah, I mean, you're referring to the chart that Mike put up there in terms of the rolling 12-month performance chart from the high equity funds.
Yeah.
I would say the probability on the balanced funds in the local environment is a lot lower, given that there's a lot of assets in there, and so I think a balanced fund on a local environment has got a lot of good drivers. A big driver is the extent to which we've seen the funds put in
Local
bonds. And
Yeah.
the bonds, yes, they haven't been great. It's been barely above zero over the last 12 months, given that the interest rate has moved up. But you know what you're going to get. It's just a matter of, if you hold that thing to maturity, you're going to get that, and obviously
You're going to get that yield,
you're going to get that yield. So your starting point where we are now is so much better. So I don't think it can get worse. I don't think it can get dramatically worse.
And global equity, I mean, so local, I mean, certainly there's a lot more value and things look, a lot more sort of stable. But I mean, globally, your global equity position. I
think global equity is definitely priced for the interest rates moves going up and the projection of higher interest rates. It's still pricing, and this is my understanding based on all the analysis that we get, for the earnings to tick up. And if earnings across the board come off sharply, that's and they have to be, and the analysts have to start downweighting those earnings dramatically.
Yeah, then we might see some further.
That's going to be it's all, I think, going to be earnings dependent now. This is going to be the key thing, and what the analysts are projecting, because so far those earnings have held up okay. There's been a mixture. It's been obviously the resource businesses, the oil and gas businesses, but that's been holding things up. But if earnings come off dramatically, or the forecast starts coming down dramatically, that's potentially a problem.
So we should know fairly soon, I guess, if Netflix is already out and the rest of them will be.
Yeah. These guys release. These are the quarterly results that they start releasing, and each one. I mean, suddenly, but we've already seen. So obviously, if you look what happened to Netflix, I mean, it came down dramatically. And then it suddenly releases results suddenly a little bit better, and sure, post the close, it was up 10%.
I think on that point as well, Tom, unfortunately, interest rates are such a blunt monetary instrument.
Correct,
And
yeah.
there's that long time lag before you see the effect in a real economy, which obviously filters into company earnings. So I think that unknown will be with us for a few more quarters.
Yeah.
As the market try and make sense of it.
Sure. Yeah.
But I think also maybe just to add to that, I mean, the ability for certain companies to pass on these increased prices is so like Pepsi came out and they were able to pass on costs quite nicely. So there definitely are certain types of companies that have more pricing power. So in an environment where inflation is high, we don't necessarily expect it to roll over and come back to 2% anytime soon. Those guys who are able to pass on those cost increases will be much better positioned. Those guys who don't have high debt levels, or if they do have a lot of debt, it's very long term and fixed. So people who aren't reliant on rolling over short term debt from that was at low levels and is now at much higher levels. Those are the kind of companies, and I think as Ian mentioned, it is very much a stock pickers environment. I mean, we've seen the kind of value managers have done well of late with the sort of oil and gas and the likes. I'm pretty sure that certain value managers from this point out will continue to do well, but there could very well be some value managers that may be still wanting to buy cheap stuff, but there's maybe poor quality companies that optically look cheap, but going forward, rolling 12 months, suddenly have liquidity issues because they can't roll their debt, aren't able to pass on price input costs to their clients, and those kind of call them value companies will struggle. So it is going to be quite important to just where you allocate.
Thanks for those questions, Tom.
Thanks, guys.
Guys, we've got a minute left, so if there's a last question, happy to take it. If not, we look forward to seeing you all again on the 16th of November. Just pencil that in your diaries for 9 o'clock. And have an awesome rest of the week, guys.